Alright, welcome to the Discord, and in this video I will literally be talking about basic trading information. So maybe get a notepad or something. There's quite a lot of terms here and it may be hard to remember all of them. However, it is pretty important you remember most of these because you will see them a lot and you will have to get used to it. So without further ado, let's get into it. Alright, first of all we have some basic terminology. Price action is basically how price moves on an asset. It can be bullish, moving upwards as you can see in this picture down on the left, and bearish is moving downwards. Consolidation is literally none of that. It's movement within a range. As you can see, there is no real trend in this image where it says consolidation. The trend is how price action is moving. Trend can be bullish, bearish, or consolidating. One of those three. There are none other. It'll either move sideways, upwards, or down. The time frame is how long each candle is open for. It can either be 5 minutes, 30 minutes, 1 second, 1 hour, a day, a week, a month. There are many different time frames, and this will also be a big factor of your strategy. For our strategy, we use liquidity, supply and demand. So we use the 5-minute time frame and potentially the 30-minute. For swing trading and longer term holding, you may use a 4-hour to the daily or even the weekly for some massive trades. Now, long or longing. A long is basically buying an asset. You're expecting the value to rise. So if I say I'm longing the pound, I'm expecting the value to rise and I'm betting that it will increase, which will make me money. Shorting is the opposite. It's selling the asset, so you're expecting the value to fall. This is not the same as closing an order and selling the order. That is different. Shorting is placing an order, and when the price goes down, you benefit off that, which can actually be a bit confusing for beginners. But yeah, it's totally a thing that happens and we do that all the time. An institution is a large financial entity. These are the people that move the market if you didn't already know. Us traders here have no impact on the market, or very little. Institutions like banks, they have huge amounts of money, and their movements and their positions cause the markets to move. An institution doesn't also have to be a bank. It could be anyone. It could be a firm choosing to pay their workers in a different country their currency, and to do that, they'll have to swap the currencies. That will cause movement in the market. It could be a big one if the payment is large. A retail trader is an individual trader, like you and me. We are retail traders. We're not institutions. If someone says that, it's just ridiculous. No, we are retail traders, and that is key. It's retailers and institutions. They're the two types of main players in the market. Now, a pair. It's the value of two assets, one over the other. So, for example, USD JPY, it'll be the value of USD over JPY. Gold, XAU USD, it's the same. You can have many pairs. You can have XAU XAG, which is gold and silver, and you're basically looking at the price relationship between both of them. A CFD. This stands for contract for difference, and this allows traders to speculate on price changes without owning the actual asset. This is how I personally trade right now. You press buy, but you don't actually own the asset. There's two types of CFDs and there's futures, which is here. These are actual contracts where you own the asset and you can speculate. Speculate is betting that it'll move in one way or another, and you do that with owning the asset. So futures, you actually own the asset, you physically have it. With CFDs, you don't have it. It's like a secondary market, contracts for difference. Some more terminology. A bid is a price buyers will pay, and an ask is a price sellers will pay, and a spread is the difference between the bid and ask. Because as you know, if you buy something, you can't sell it for the same price. You have to sell it for a bit less. It is just how it works in the markets, and you will definitely find out about spread, which is the difference between them. The slippage is a difference between expected and actual fill price. Now, this doesn't actually occur a lot if you're trading well, but if you trade during news, prices will move so much that your order will actually get executed at a different price to where your stop loss is, which sounds a bit unfair, but it definitely happens, and this is a very big deal. This can cause your account to be blown, because obviously stop loss manages risk. If your stop loss isn't really working, you'll be risking either way more or way less. And you can have positive slippage. Price can hit your TP and go even further than that and fill your order way above, which means you get more money, which is good. But you just want to be careful. A pip is the smallest price movement. We measure distances using pips. It's like centimeters in real life, but you can't do that on the charts. So you measure distances with pips. 100 pips, 50 pips, 8 pips. A lot is a standard Forex position size. Now, this is quite tricky to understand, so this is why you kind of have to just start, trading. You will get used to this stuff. A lot is how you enter the markets, and it's quite tricky to calculate. You have to calculate how many lots are to risk a certain amount, and there are many kind of apps that you can do this with. I have an app on my phone, and we also use a thing called Magic Keys, which I'll explain in a bit, which definitely helps a lot with calculating your risk. A market order is buying and selling immediately at the current price. And a limit order is buying and selling at a specific price. A stop loss, as you've already heard, is an auto close position at your set loss level. This limits your loss. These are essential. If you have no stop loss, you can just lose everything. A take profit is the opposite, auto closing your position at your profit level. And trailing stop loss just means instead of having the stop loss fixed, it moves up as price moves up. And as you can see in the bottom left, this is an example of a stop loss and take profit. The stop loss is that red line at the top, and the take profit is that green line at the bottom. And where they meet in the middle is where your entry was. So if price goes above that red area, you close the trade automatically, and it's the same if it goes down and goes past the green area. And in this situation, we are shorting the market, we are selling. Risk to reward. This is the potential loss versus potential gain ratio. And in your strategy, this will be very important. Now, liquidity is where stop losses cluster. You know, a stop loss, that is where your position is. If you lose, it will close your position. Liquidity is where lots of stop losses are, pretty much. And this will be explained more depth in further videos, as it's quite a complicated topic. But this is very important for understanding the markets. Price and big banks need liquidity to enter positions. And that sounds like a bit of random words, but I will talk about it in another video. A journal is where you write all your trades. This is fundamental to being profitable. If you don't have a journal, you'll never know at all if you're doing good or bad. Your weekly profit, your monthly, yearly, mistakes you're making, stuff like that. You need a journal to write down how you're trading. It is absolutely fundamental and key. A prop firm, a company that provides traders with capital in return to keeping a small percent of profit. This is a crazy concept, and I'll explain it in a bit. But yeah, companies seriously will give you money to trade if you're a good trader, and they'll just keep a bit of it for themselves. However, there are many scams. I got scammed with Beamer, my cousin. That was absolutely crazy. We lost a decent amount of money, and that was devastating. So just be very careful about prop firms, but we have some good ones you can go with. Funded, if you're a funded trader, that means you pass your prop firm challenge, which allows you to receive real profit from trading. Being funded is aura. As I say, it's insane. And if you are a funded trader, you can make money from trading, which is obviously what everyone really wants, isn't it? TradingView is an application where you view your chart data. MetaTrader 4 or 5, there's two versions, it depends, old and new, is an application used by many Forex prop firms to place trades. If you're on futures, which I talked about earlier, they have slightly different ways of placing trades. But for many people who are trading CFDs, which is what we trade, on MetaTrader 4 and 5 is where you'll place your positions and most likely be calculating your risk using magic keys, which is used on MetaTrader. Now let's get into some more stuff. So, candle type. Candles show the movement of price. Even if they have no color, you can understand how price moved. Every time a candle closes, a new one will open, unless it's a weekend where the markets are shut, or there are the electronic trading hours where the markets close to Asia. A 5-minute candle will open, have price movement up and down, and then close after 5 minutes, and the next one will open. For the 4-hour time frame, 10-hour, even if you do that, the weekly is the same. For the weekly, it will open, move for a week, and then close, and the next one will open, move for a week. And as you can see in this diagram, it's pretty simple. The body is literally the body of the candle, it's the colored bit. The wicks are the highest and lowest points where price moved during the time it was open. So if price is here, moves up here, then comes back down, it'll create a wick. And there are many different types of candles. As you can see, they look very differently. Some don't have a lower wick, some do. Some have only wick, some have no body. Some are normal, some have a tiny body. There are tons, and it doesn't matter. That's just how the market works. Bullish candles, they open at the bottom and close at the top. And bearish candles, they open at the top and move down, closing at the bottom. And you'll very quickly understand how these candles work just by watching the markets. And as I said, if there's no color, you can literally still start understanding which way it closed. Now, TradingView. This is an app where you analyze the charts. This is where we find our setups, and pretty much everyone uses TradingView, unless there's some weird competitors. You can have your pairs list on the right, and as I said, a pair is a combination of assets like XAUUSD. You can analyze the price action of pairs on TradingView, and each candlestick shows the change in price. It's that simple. We just use TradingView to analyze the charts. For us, we don't place any trades on TradingView. We place them on MetaTrader. Remember that. Let's get into it. Market structure. A swing low is a significant low formed in the trend. A swing high is a significant high formed in the trend. And if you just look at this image, it's quite easy to understand that. It's very intuitive, these names, kind of. So a swing low is literally a low. You can see it in the market. There's one at the bottom, there's one in the middle, and there's one also in the middle. A swing high is the opposite. It's just a high. The market moves up, down, up, down, up, down. The low and high points are called swing highs and swing lows, and you can really easily mark them out. Now, a breaker structure is simply when price passes through a swing high or swing low. Now, if you analyze this diagram, you can see there was a negative breaker structure or bearish breaker structure with the red text. This is because there was a swing low, then price came down and actually went past it, which breaks the structure of the swing low. It's the same with the swing high. There's a swing high on the top, price goes past it, which means it broke the structure of the swing high and it's a bullish breaker structure. And these are very good to determine trends. It's very easy. If they're a bullish breaker structure, it's more bullish. If they're bearish ones, it's more bearish. It's consolidating, there's both or not a lot. And a change of character is when the trend starts potentially reversing. And we'll talk about trend now. A bullish trend. This is when we have higher highs and higher lows. It's pretty easy to see. It starts at the bottom and ends at the top. And this can be indicated by multiple bullish breaks of structure. If a bullish break structure occurs, we can form a higher high. And this means that the price is getting higher, break structure higher, break structure higher. You can see in this diagram, this is pretty much it here. You have swing highs being broken, swing high broken, swing high broken, swing high broken, and the swing lows are being created. They're not being broken. And this in turn forms a bullish trend. You obviously don't have to label this all. You will start pretty quickly analyzing it, but it does help to see the breaks of structure because that can definitely determine if it's a more tricky trend to see if you're potentially bullish or bearish for the bias. A downtrend, a bearish trend, is the opposite. It has bearish breaks of structure. And you can see here, price goes down, retraces, goes down, forms a breakage structure, retraces, goes down, forms a breakage structure, and retraces. And in the image, you can see that too. These swing lows, these low points, are being broken and broken as price is wanting to push further and further down. However, these swing highs are just being created. Price doesn't want to push up. It doesn't want to break past the previous level. It wants to break down. And this makes it a bearish trend. And again, it's pretty easy to see. Bearish trends start high and at the end, they go lower. As I said, they can be indicated by multiple bearish breaks of structure. You don't have to mark out all the swing highs, but marking out the breaks of structure can be very useful. Finally, consolidation. Now this image may be a bit more confusing, but it's the same kind of principle. In consolidation, we do not really see any set trend, obviously. We see a combination of higher highs and lower lows, or lower highs and higher lows. These swing lows are being broken. These swing highs are also being broken. And they're also not really being formed on their own. There's not really any set kind of direction. And you can see, it literally started, moved along, and ended in the same position. Price moved nowhere over this course at all. Finally, a change of character is when the trend switches. So, a downtrend reversing to an uptrend. Signaled, in this situation, by two breaks of structure to the upside, which is upside is upwards. As you can see in this image, we have a bearish market at the start. There are breaks of structure going down. This is because price wants to go downwards, it is bearish, and it's creating these swing highs. You can see pretty visually, it's quite simple to see, you don't always have to mark out as I said. However, price then fails to continue breaking the structure of these lows. If you look down in the middle, you can see the swing low, price fails to break that swing low. And instead, it goes up, and then suddenly it goes up, and causes bullish breaks of structure. This is a change of character. Price has changed from going bearish to bullish. And you can use this in your trading to signal a change and potentially an entry. Now, a prop firm. These are companies that provide traders with capital, in return keeping a small percent of your profits. They normally keep 20% of your profits if you're funded. It's a crazy concept, but it's literally true. People will give you money to trade, and only if you pass a test. This test will be to hit a profit target, often with a bunch of weird rules. These rules include maximum daily losses, maximum overall losses, and with these rules, the profit target is usually around 10%, the maximum loss is around 10%, and the daily loss is around 5%. And obviously, the S&P averaged about 16 or something percent last year, so you have to make good returns to pass these fundeds. We personally use Alpha Capital Group, which is ACG, which are a really good firm. I think they're the best right now currently. And alongside FTMO, which have been in the market for ages, these guys specifically have really cheap accounts, which we have special discounts for. Prop firm accounts, they could be 10k with a minimum start at 10k, 25k, 100k. You can't just withdraw the money. No, you can't withdraw 100k. They're all on demo, always. And many of these firms are scams. We ourselves, as I said, got scammed at the start of our trading journey. We will find any reason to not give you a payout. Any reason. These firms get their money from people failing, not from people trading. Well, most of them. Now, MetaTrader. This is pretty simple, although the interface looks incredibly complicated. It's like a spaceship when you first open it. This is an app that allows you to place trades. For these prop firms, you'll have to download their specific broker app. So for ACG, you go on ACG, then download their version of MetaTrader, which just have their server on it. It is complicated, but you'll get used to it. And to enter a trade, as I said, you have to calculate the lots. And this is the amount of units you're buying. This is complicated, so we use a software called Magic Keys, which costs a bit of money, it's like 30 quid. But this definitely simplifies the process a lot, and it's a lifesaver, to be fair. I think there are some free ones as well. And Beamer FX on YouTube has a good Magic Keys tutorial, which you should watch to understand. And I expect there are a bunch about MetaTrader 5 in general. It is one of the most used softwares for placing your trades. Now we have backtesting. This is how you actually test your strategy, and it gives you confidence in your strategy. This is absolutely fundamental if you want to actually be a trader, because you need to know what you're trading. You have to test it and see what kind of results you are expecting. Good metrics are win rate and stuff like that. The win rate will tell you how much times you win, and your average IRR tells you the amount of return you normally get. And to backtest, this can be done in replay mode on TradingView, or websites like FX Replay and TradeZilla. To save your backtesting data, you can either use Excel, or you can use our website called TradeSave Plus. And this is really good for kind of saving your data, because you can actually set inputs. You can set like, trend, is it bullish or bearish, your confidence, time of day, and then you can compare all of them and see which factor is the best, which is really, really easy. On Excel, it takes a while, really hard to see the true statistics of your data. And that is it. That is pretty much the introduction. And if you continue with this playlist, there will be more videos about our strategy. But yeah, hopefully this taught you something, and thanks for watching, and stay active, Cheers.